But of course, the big story of the morning does remain that May jobs report, which came in better than expected. We saw a robust but slower pace of hiring from April. You can see 390,000 payrolls added in the last month. The unemployment rate held steady at 3.6%, despite the street's expectations for 3.5% and 318,000 on the top line, 5.2% year over year. Wage gains, a lot to unpack in that report. So let's get right into it with PIMCO U.S. economist Allison Boxer, who joins us live on the program. Allison, thanks so much for stopping by this Friday morning. I just kind of want to get your initial thoughts on the jobs report. What does it tell you about the strength of the U.S. economy, at least in May?
Thanks, Brian. Thanks for having me today. I think the overall message from the jobs report was that the labor market remains very strong. We clearly have a very hot U.S. labor market. But I think as you start to dig under the surface and look at some of the underlying details, I think we are seeing some sort of early signs of some inflection, perhaps some cooling ahead in the months to come. So, for example, if you look at the sector detail, we actually saw some meaningful job losses in the retail sector versus very strong job gains across other service sectors. And I think overall, this was sort of consistent with the fact that we have a very strong U.S. labor market, strong wage growth, low unemployment, things looking very healthy overall. But we are seeing some transition, some goods to services rebalancing, and perhaps some signs of a little bit of an inflection in the labor market.
So when you say signs of an inflection, the story so far in this recovery has been it's a workers' market. They can pick and choose what types of jobs they want to take. Employers are trying all they can to plug the many job postings that are out there. When you say that inflection point, are you suggesting that maybe that May jobs report is showing that dynamic is starting to change a little bit?
Yeah, I think we're starting to see early signs of this. Again, still very much a workers' market. Wage growth looks quite strong. But I think we're starting to see somewhat better supply-demand balance in the labor market. We got the JOLTS report earlier this week, and job openings remain near record levels, but they do appear to be ticking down, especially when you look at the sector-level detail. And then similarly, hiring very strong, but appears to be, at least maybe moderating a little bit. And then similarly, again, wage growth extremely strong, but looks like it's stabilizing instead of spiraling higher.
Something that caught a lot of attention this morning was specifically the prime age labor force participation rate. This covers those that are kind of in between, I believe it's 25 to 54. What did you gain from that, given that we've actually recovered a lot more than perhaps people thought? There were some policymakers during the midst of the recovery that were saying, look, it's not entirely sure that we'll be able to get that labor force participation rate as high as we've gotten it.
Yeah, I think we've gotten really good news, both for the Fed outlook and the inflation outlook, as well as sort of the health of the U.S. economy longer term from the participation gains that we've seen, not just in today's report, but really fairly strong year-to-date participation rate gains. And as you note, a lot of this has come from this prime age part of the population. I think this is really important and again, really good news for the long-term health of the economy. If you think about the U.S. economy overall, the U.S. faces an aging population. Demographics mean that we're going to see retirements over time, and this sort of naturally reduces labor supply. So in order to keep labor force participation up, you really need to see gains from these prime age people. And I think the fact that we are seeing this, that a strong labor market, similar to the experience prior to the pandemic, is bringing these people back into the labor force, is really good news, both for sort of the overall long-term trajectory of the economy, as well as the ultimate inflation outlook too.
I was reading your note ahead of this interview, and you were kind of flagging that there could be a divergence between sectors in the labor market recovery. And even though on the headline basis, we're seeing jobs get added to the U.S. economy as of the last month, it's not going necessarily to all industries. And we saw, in fact, a contraction in retail, even though we saw a gain in leisure and hospitality. What is that telling you about the evenness of the recovery, at least as far as this stage?
Yeah, I think it's consistent with this idea that the U.S. economy is going through some rebalancing this year. We're moving out of two sort of very abnormal years in the pandemic. And I think one of the big pandemic trends that we saw that now seems to be reversing in this jobs report is this sort of goods versus services trade-off. So during the pandemic, lots of online shopping, lots of demand for goods as people were forced to stay home. And I think this labor market report was another sign that we're really starting to see a more normal post-pandemic period as people transition back to services, to going to restaurants, to staying at hotels. Instead of just buying goods as they're stuck to stay at home, we are seeing this rebalancing. And I think that's what we saw with the loss of retail jobs today.
And then last question here, just kind of big picture. You've been hearing a lot of commentary from the likes of JP Morgan Chase CEO Jamie Dimon that there's this hurricane of recession coming by. But look, when you look at the labor data, it seems like the U.S. worker is still in a pretty good dynamic where you're getting wage gains. And yes, inflation might be outpacing that. But overall, it seems like the amount of people in jobs now is a much better picture than people thought perhaps in the midst of 2020. Is there anything in this May jobs report that tells you a recession is around the corner?
Yeah, so certainly, I think we've seen a much faster recovery in the labor market, over the past 2 years than was initially feared, especially if you rewind to the early days of the pandemic when we just saw soaring unemployment. So certainly, things looking quite strong. I think we're certainly seeing that the labor market is still in a very healthy place. The fact that, we're seeing people come back into the labor force, we're seeing low unemployment, certainly doesn't suggest any signs of economic danger. But I think we are certainly, again, seeing some inflection points, seeing some sectors that are stronger than others. And so ultimately, our outlook is that we are going to see growth slow. But one of the reasons why, recession is not yet our base case outlook for the U.S. Is the fact that we're starting from this very healthy point. Household balance sheets look good. The unemployment rate is very low. So again, I think certainly some inflection ahead, some slowing ahead. But at least for now, I think the healthy starting point, suggests to us the recession is not yet the base case, even if it's an elevated risk.
Allison Boxer, economist over at PIMCO U.S. Thanks so much for stopping by.